This was the week that EU leaders settled on a new budget for the region, including the first cuts to EU spending in its history. It was also the week that Japan managed to put the brakes on deflation, marking the first time in 7 months that prices have not fallen. I'm Natalie MacDonald, bringing you the weekly wrap-up with today's guest, Timothy Davis of TD Securities. Timothy, what for you has been the market-moving event of the week? Are we still seeing reactionary movements from last week's FOMC announcement, or have there been other clear drivers?
I think we are still seeing a reaction to the FOMC, but there have been some other key factors this week as well, which are rather noteworthy. Probably the most key of these has been an easing of concerns surrounding Chinese liquidity. There's been lots of focus on what the People's Bank of China's stance has been here, and they have continued to sound none too concerned with developments at the moment. Indeed, we've seen money market rates in China have fallen significantly now, and going forward into next week, they should be much less of a driving factor. I think the other key factor, in addition to the FOMC and Chinese liquidity, has been the poor GDP revision in the US, which has made the market tone down its concern a little surrounding tapering.
This week also saw UK Q1 GDP revised down to 0.3%, as Britain's Office for National Statistics claims that Britain suffered only one recession since the 2008 financial crisis, erasing the double-dip recession. How is this likely to impact UK monetary policy?
Well, I think we put a little bit less emphasis on these revisions than some other analysts at this point. There are a few things that we'd like to note on this. Firstly, the Bank of England actually used their own measure of GDP, so they, as well as doing a GDP forecast, they do a GDP backcast, so they don't rely solely on the ONS figures here. So although the headline numbers have changed quite a lot, the numbers that the Bank of England used may not have changed so much. But having said that, there obviously were some sizable revisions going back. It's now estimated that output in the first quarter of this year is 3.9% below the pre-recession peak, as opposed to the 2.6% previous estimate. Although this is obviously fairly backward-looking data, and the quarter-on-quarter growth for the first quarter this year was unchanged at 0.3%, it is something that some other analysts are putting quite a lot of emphasis on. We think that although it may show that the output gap is very slightly larger than we would have thought before this data was released, the impact going forward is a lot more to be seen in the data to come out ahead of. And we think that the most obvious of these is the outlook for the economy. Momentum going forward matters much more than previous data. If this had been the only factor and yields had not risen recently, then we would have expected to see little action from Carney, with some kind of forward guidance fairly likely but not certain. We think that the rise in yields, is a much more important factor for the future direction of policy than these revisions to GDP data. Therefore, we don't think that QE being resurrected is that strong a possibility at this juncture, and we do expect to see forward guidance, although we might have to wait until the August meeting when the inflation report is released, rather than seeing it in next week's meeting.
German bonds have slumped aggressively in the wake of the US FOMC monetary policy announcement, striking 8-month lows in this week's trading. With several positive items coming out of Germany's economy today, including inflation, employment and retail sales data, can we expect a pickup in Bund performance in the short term, or will German bonds continue to fall?
Yeah, I think there's a good chance that we could see a pickup in Bund performance in the short term. We've already started to see yields start to fall in Bunds, and we think that the current levels are pretty key here. We think that the 1.72% level is pivotal, as it has significant implications from a technical perspective. For example, if you look at a weekly candle chart, it appears as though we could be closing the week with a shooting star formation, which should basically suggest that yields are likely to fall from here. This kind of this should be viewed in conjunction with the data that we see released next week. Although we're fairly light on second-tier European data, we do have a couple of key releases in the PMIs and the flash CPI next week. And both of these events precede the ECB rate decision and Draghi's press conference. The ECB do cut rates, which at the moment we don't expect, but if they do, there is a good chance that they can sound pretty dovish here. Then that might be the trigger we see to start to see yields to fall back further.
As we look forward then, what would be your pick for next week's market mover?
We think that that both 5-year gilts and German 10-year Bunds have a good chance of appreciating here. I think on both of those there are fairly big risks, so you would have to kind of go into those kinds of trades with your eyes open to these risks, and the biggest risk in our view is obviously we have the central bank meetings of both the Bank of England and the ECB next week, and we've got the US employment report towards the end of next week too. So with that being released the day after Independence Day in the US, that could have a large market impact in what could be a pretty illiquid market.
Timothy, thank you very much. That's all for now, but for more on today's positive German data, take a look at Elaine Stenson's press review. From all of us here at Dukascopy TV, goodbye and have a great weekend.